Hello everyone, it's Dan Boodoo from Kensington Accounting. We are an online course provider specializing in accounting. This video is part of a series of revision videos for IGCSE and O-Level in accounting. Today we will be reviewing the IGCSE Accounting June 2020 Paper 1 Series 2 from Cambridge. A quick note of my profile so that you have an idea who is your tutor. We also offer the following courses as shown on your screen. Please visit our website for more details. Now let's go straight to the questions. Paper 1 has 35 questions and we will be reviewing all of them, so please be patient. Question 1 deals with the difference between bookkeeping and accounting. Bookkeeping is essentially about the recording of financial transactions, whereas accounting is using the records prepared by the bookkeeper to do more complicated and sophisticated tasks like preparing financial statements, analyzing financial data, interpreting financial data, and communicating those financial data. Now, based on these definitions, when we look at the question and the four possible solutions, if we look at item 1, it says entering details of a check received from a customer in a cash book. Yeah, so entering details of a check, that's part of record keeping. So that seems a correct answer. Number 2, entering details of goods purchased. Yeah, entering such details of a transaction is part of bookkeeping. Thirdly, producing an income statement. Producing income statement is part of the function of accounting, which is preparation of financial statements. Therefore, number 3 is not part of bookkeeping. Number 4, recording details of credit sales. Yeah, so recording of credit sales as part of bookkeeping. Therefore, the 3 correct answers are 1, 2, and 4. Therefore, the correct answer is B. Question 2 is how does a trader, therefore the owner, use the information provided by financial statements? In other words, what are the uses of financial statements? Now, do we prepare financial statements to calculate cash drawings? Obviously, no. Do we use or prepare financial statements to calculate trade receivables? No. Do we prepare or use financial statements to find out what is the bank balance on the bank statement? Obviously, no. D, to compare the business performance over a number of years. That's correct. That's one of the main purpose or use of financial statements, is to use information provided in the financial statements for various years to calculate ratios so that the owner or the trader can compare, evaluate, and interpret the business performance over a number of years. Therefore, the correct answer is D. Question 3 is about the double entry for a particular transaction. In this case, a trader has bought new fixtures. Now, fixtures is part of non-current asset, and the payment he's paying half cash and half to be paid later. Therefore, it is on credit. Now, the double entry for such a transaction would be to debit the fixtures account in net current assets by the total amount of the purchase. Obviously, is paying half in cash, therefore the cash account needs to be credited by 50%, and the other 50% will credit the business which has provided the credit, which will be the other payable account in current liabilities. Therefore, the effect of this transaction on assets will increase by 100%, but also decrease by 50%. Therefore, the assets is increasing, total assets is increasing by 50%. In terms of liabilities, other payable is part of current liabilities. Therefore, the liabilities will also increase by 50%. Effect on equity. Now, equity is essentially capital, profit for the year, capital introduced, and drawings during the year. None of these balances, either the opening capital or profit for the year, or capital introduced, or drawings for the year, is being affected by this transaction. Therefore, the effect on owner's equity is nil, that is no effect. Therefore, the correct answer is D. Question 4. Nina received a check from Jafar, a credit customer. On 12 of April, the check was returned unpaid by the bank. What entry would Nina make of this return of check? Therefore, a return of a check from a customer is also known as a dishonored check. So the question is about what is a double entry for dishonored check from a credit customer. Now, the double entry for a dishonored check is the complete opposite of the double entries for a receipt from a credit customer, because what is happening here, we need to reverse the original entry when we or the business received a payment from the credit customer. Now, the double entry for receipt from a customer is debit bank, credit the customer's account. Therefore, the double entry for a dishonored check will be the reversal or the opposite of that entry. Therefore, the correct entry will be to credit the bank account and debit the customer's account. Therefore, the correct answer is D. Question 5. Anne is a trader. On 1st April, Cindy's account in Anne's ledger showed a credit balance of 520. Therefore, Cindy is a credit supplier to Anne, and Anne owes money to Cindy of 520 on that particular date. Now, there are two transactions. Transaction 1 is on 2nd of April. Anne returns goods $30 to Cindy. Now, when a customer returns goods to a supplier, this will reduce the amount owed by the customer. Therefore, the effect of a purchase return, because Anne is returning goods bought initially from Cindy, that's a purchase return. Therefore, the amount owed will go down by 30. So initially 520 was the original balance, less 30 for purchase return. Amount owed on 2nd of April after this transaction will be 490. Now, on the 14th of April, Anne bought goods to 10 from Cindy but paid in cash. Now, this is a cash purchase. A cash purchase is not entered in the supplier's account in the purchase ledger. It is not entered because it has paid cash, and therefore it doesn't change the amount owed by Anne to Cindy. Therefore, there is no effect on the amount owed. Therefore, 14 would not change, the transaction of the 14th of April would not change the amount owed. In other words, at the end of the month, the amount owed by Anne to Cindy will still be 490. Therefore, Anne owes Cindy 490 at the end of the month. Therefore, the correct answer is A. Question 6. Goods bought on credit by Tumelo. So, therefore, Tumelo is buying goods on credit. And Tumelo has returned the goods before they were paid for. Tumelo keeps a double entry system. Where will Tumelo record the return of goods? Now we need to find out whether it is a purchase return or sales return. Now in this case, Tumelo is a purchaser. Okay, when Tumelo is returning goods, we're talking about purchase return. Okay, therefore, what is the double entry for purchase return? The double entry for purchase return is we credit the purchase return account and we debit the supplier account because it was bought initially on credit. The purchase return is part of general ledger. It is an account in the general ledger, and the supplier's account, it is an account in the purchase ledger. Therefore, the question is, where will Tumelo record the return of goods? Now, let's look at the four possible solutions. A is talking about cash book and sales ledger. Obviously, that's wrong. B is talking about general ledger only, which is also wrong because we're talking about both purchase ledger and general ledger. Therefore, this is wrong. C seems fine. D is talking about purchase ledger only. That's also wrong because we're also talking about the general ledger as well. Therefore, this is also wrong. Therefore, the correct answer is C. Question 7. Therefore, Dave is a supplier to Peter on credit. Peter obviously is a customer. Peter owes money to its supplier Dave for $40 at the beginning of the month. During the month, Dave, as a supplier, sends and receives the following documents. Therefore, Dave sent an invoice. He was paid $4.29 by the customer. He also received a debit note from the customer, and then he issued a credit note during the month. What we need to find out is what is the closing balance owed by the customer Peter to Dave at the end of the month. So let's go item by item. Now, first we must note a debit note is only a request. Yeah, a debit note is only a request, okay, issued by the customer. Okay, it is not accounted or recorded by the books, both by the supplier and the customer. None of them records a debit note because it is only a request, and therefore the debit note for accounting purposes should be ignored. Now let's go item 1, talking about the invoice. So invoice 360, it means that Dave sold goods to Peter for 360. Therefore, initially the balance owed by Peter was 440. Now the invoice, okay, the invoice will increase the amount owed by Peter to Dave. Okay. Second transaction is a check received, okay, from Peter. Now the amount paid is 429. Okay, therefore this will reduce the amount owed by Peter to Dave, but there was also a cash discount. Now, when a supplier gives a cash discount, it reduces the debt of its customer. This is known as discount allowed. Therefore, the discount allowed will also reduce the amount owed by the customer. Now, debit note, as we have seen before, should be ignored. Lastly, a credit note. A credit note is a credit given by the supplier to a customer for return of goods, and therefore that reduces the amount owed by the customer to a supplier. The closing balance is 310. Therefore, this is the amount owed by Peter to Dave at the end of the month. Therefore, the correct answer is B. Question 8. A business sold goods with a list price of $50 each. So that's per unit. Yeah, it is for each unit is $50. And the terms of trade is a trade discount is given for more than 20 items bought. Okay, you get a 10% discount for more than 20 items bought. And a further discount, a cash discount, which is a discount allowed if the customer pays within 30 days of 4%. Now, in the question, is asking what was the amount received in full from a customer who buys or bought 25 items but pays 35 days later. Now, the first thing, because the customer is buying more than 20 items, the customer will get the full discount of 10%. Okay, the trade discount of 10% in full. Secondly, because the customer did not pay within the 30 days, the customer will not receive the cash discount or the discount allowed. Therefore, the amount of settlement will be only the invoice amount, as the customer will not obtain the cash discount. The invoice amount is 25 items multiplied by the list price of 50 less the 10% trade discount. Therefore, that's 1250 minus 125 is 1125. Therefore, the correct answer is C. Question 9. Paul rents premises from John and pays the rent by credit transfer. How would John record this transaction? Okay, so John is a landlord. Okay, so John is a landlord. Okay, and the transaction is John is receiving money from Paul. Okay, so John is receiving money for rental income, because we're talking about premises rented to Paul, and Paul is paying rental income to John. Okay. Therefore, the question is referring to the double entry for receipt of rental income. Now, a receipt, obviously, you need to debit the bank, okay, cash, bank or cash. In this case, it's talking about credit transfer. Therefore, we're talking about bank. Therefore, the double entry is to debit bank. Okay, bank account, debit. Okay, and the credit is obviously to the rental income account, also known as the rent receivable account. So that's debit and credit. Therefore, the correct answer would be A. Question 10. Sita discovers that $1,000 received from the sale of fixtures. Now, fixtures, it is a non-current asset. So we're talking amount received, okay, for the sale of a non-current asset. So therefore, this is proceeds from sale of a non-current asset rather, has been entered in the sales account. Okay, so we're talking about the proceed from the sale of a non-current asset, and the correct entries for proceeds from disposal or sale of a non-current asset is the debit the bank or cash, and credit the disposal account of that particular non-current asset. However, the question is referring only to credit entry. Okay, therefore, instead of crediting the disposal account, the sales account was credited by $1,000. Now, how do we correct it? We need to obviously reverse that credit entry to the sales account. Therefore, we need to debit the sales account, and obviously we need to credit the disposal account to correct that mistake. Therefore, we need to debit sales account and credit disposal of fixtures account. Therefore, the correct answer is C. Question 11. The total in the TB did not agree by $200, and the difference was a debit balance on the suspense account. Later, 2 errors were discovered. Let's look at each item. Item number 1. Now here, an invoice of $700 was wrongly recorded as $770. Now the effect of this is that the posting to the sales ledger account, the customer's account in the sales ledger, will be overstated by 70. And for that reason, the trade receivables, which is a debit balance, will be also overstated by $70. Now, because the entry is 770 in the sales channel, the total sales figure will be also overstated by $70. Therefore, the posting to the sales account for that month will also be overstated by $70. So both the trade receivables and the sales account will be overstated by $70. Therefore, the trial balance will still agree. There will be no difference because both the debit side and the credit side will be each overstated by $70, and therefore this suspense account is not affected. Now, because we still have a $200 difference, that would mean the $200 difference is due to error number 2. Okay, it is error number 2, which is in fact causing this difference. Now, what does that mean when there's a debit balance on the suspense account? That means the credit total, okay, the credit total, that is the total of the credit balances in the TB, is greater than the debit total on the TB. Okay, now because we know that the difference is coming from sales journal, that would indicate that the sales account, that the sales balance in the TB is higher by $200. Now, for the sales to be higher or overstated by $200, it means in the sales journal the total or the casting has been overstated. Therefore, there's an overcast of $200 in the sales journals. Therefore, the correct answer is B. Question number 12. A business has a loss of 16,000. Okay, it has later discovered 2 errors. We need to find the effect of these 2 errors on the loss. Item number 1, no adjustment has been made for insurance prepaid. This is a year-end adjustment for prepayment of expenses. Now, the double entry for prepayment of expenses is to credit that expense account and debit other receivables. Crediting the expense account will reduce total expenses. Reducing total expenses will also reduce the loss. Therefore, initially there was 16,000. Now this prepayment adjustment will reduce the loss by 480. Item number 2, there has been an omission of bank charges. To correct this error, we need to debit bank charges and credit bank. Debiting bank charges will increase total expenses, and therefore this will increase the loss for the year. Therefore, we need to add 620. The revised loss will be 16,140. Therefore, the correct answer is C. Question 13. What would result in a cash book balance being lower? So very important, lower than the balance on the bank statements. So let's look item by item. Item A. A check received from a customer was not recorded in the bank statement. It means a check deposit was posted in the cash book but not yet credited in the bank statement. This is also known as uncredited or not yet credited or outstanding deposit. This will cause the cash book balance to be higher because the deposit has been recorded in the cash book but not yet shown in the bank statement. Therefore, the cash book will be higher, not lower. Therefore, this is not correct. Item B, a customer's check dishonored by the bank appeared only on the bank statement. Therefore, the bank statement has recorded that check dishonored. Therefore, the bank balance on the bank statement will be lower, and the balance on the cash book, because it has not yet recorded in the cash book balance will be higher. Therefore, this is not the correct answer. C. Payment made by a customer directly into the bank account was not recorded in the cash book. So basically, a customer has paid a deposit in the bank account. So it is showing in the bank statement, but has not yet been recorded in the cash book. So a deposit not recorded in the cash book will make the balance on the cash book lower. Okay, so this seems to be the correct answer. And lastly, D, a payment was not recorded in the cash book of a standing order. So not recorded in the cash book, it means the cash book balance is higher because a payment has not been recorded, but in the bank statement it was recorded. So this is not the correct answer. Therefore, the correct answer is C. Question 14 is about books of prime entry. We have two items. The first item is about returns by credit customers. So we see we're talking about sales return, and the books of prime entry for sales returns is a sales returns journal. Item number 2, irrecoverable debts. Now it's very straightforward. The books of prime entry for irrecoverable debts is general journal. You have some additional notes here, and the important thing is to note the general journals includes all entries which are not entered, okay, in the other 6 books of prime entry. Obviously, irrecoverable debts is not entered in the other 6 of books of prime entry. Therefore, the book of prime entry for this item is general journal. Therefore, the answer is D. Question 15 is about capital expenditure. Okay, capital expenditure is money. Okay, is money spent on purchasing of non-current assets and also the improvement or an extension of an existing non-current asset like a building. Okay, any expenditure also incurred on the purchase of a non-current assets like carriage or transportation, decorations, installation, or legal fees on the acquisition of that particular non-current asset is also capitalized and treated as capital expenditure. However, things like repairs, painting, decorations, which are done at a later stage for existing or original buildings, this is treated as a normal repair and maintenance, and it is a revenue expenditure, not capex. So that's a revenue expenditure. Okay, so let's see various examples of expenditures. Decoration cost to a new building, so to a new building is a capex, but to an existing or original building is a revenue. Delivery charges for the purchase of a non-current asset, that's capitalized, it's a capital expenditure. Aircon, whether to an old or new building, aircon is an equipment, obviously it's a capital expenditure. Legal fees on the purchase or extension of a non-current assets, that's also capitalized, it's a capital expenditure. Nameplate cost for a new motor vehicle is part of the motor vehicle when bought, is part of the capital expenditure. Wages of employees installing, so the word installing is very important, it's part of the installation cost and it is a capital expenditure. Okay, therefore cost of the machine, delivery charges and installation cost are all capitalized and capital expenditure. However, insurance, the normal annual, okay, it's an annual expense, and it is considered as a revenue expenditure, and it is expense, and it is not considered as a capital expenditure. So going back to our question here, the cost of machine is a capital expenditure. The delivery charges for the delivery of that particular machine is also a capital expenditure. Insurance is not. Insurance is a normal annual recurring expense, is a revenue expenditure and not capital expenditure. Wages, because it talks about installing, it's part of the installation cost and it is considered as a capital expenditure. Therefore, the answer is 32,000 plus 1,800 plus 1,300. The answer is 35,100. The answer is C. Question 16 is about depreciation. The two methods of depreciation is straight line method and reducing balance method. So it says here a non-current asset was depreciated for the first year using the straight line method. Later it was found that it was an incorrect method. The correct method is in fact the reducing balance method. So what was the effect on the profit of correcting? So So when you correct this error, what happens to the profit? Okay. Now we need to calculate the depreciation charge under each method. So initially, the depreciation on the straight line method is cost minus residual value divided by the useful life. That's 20 minus 4,000 divided by 4 years. That's 4,000. Using the reducing balance method is a percentage times the cost. So that's 6,000. It's very important to note. So it's a trick here. Very important to note that when we use the reducing balance method, okay, we must ignore the residual value. Why? Because the percentage of 30% used in the reducing balance method already takes account of the residual value. Therefore, if you include the 4,000 again under the reducing balance method, will be double counting the residual value, and obviously that would be a mistake. Okay, so initially it was 4,000. The correct answer is 6,000. Therefore, depreciation, okay, has gone up by 2,000. Okay, and the effect of the correction of this on profit is that profit will go down by $2,000. Okay, so profit will decrease by 2,000. Therefore, the answer is A. Question 17 is about depreciation using the reducing balance method. So a trader purchased a motor vehicle costing $8,000 1st of January 2018. The depreciation rate for the reducing balance method is 40%. What is the journal entry to record the depreciation in year December 2019? So that's December 2019. Therefore, it's second year, because the first year will be year ended 2018, and the second year it will be year ended December 2019. So depreciation for the first year will be 40% times the cost. That's 3,200. And depreciation for the second year using the reducing balance method is a percentage multiplied by the net book value. Okay, so this is a method of reducing balance. For the second year, we use the net book value, not the cost. So the net book value is 8,000 minus 3,200. So the difference is 4,800. So it's 40% times 4,800. It's 1,920. Therefore, the depreciation charge for year 2, yeah, we're talking year 2, okay, will be obviously debit the income statement and credit the provision for depreciation charge. Therefore, the correct answer is A. Question 18 deals with opening balances for income. So commission is an income, and rent receivable is rental income. Now, income outstanding, also known as accrued income, means the customer owes money to the business for services already provided. It is a current asset because it is money owed by customer to the business, and obviously a current asset is a debit balance. Therefore, this commission receivable, okay, represents amount owed by the customer to the business. Therefore, it is income outstanding. Okay. Income prepaid means a customer has either overpaid on his account or paid a deposit. This is money which the business owes to the customer, and it is a current liability and a credit balance. Therefore, in this case, rent receivables with a credit balance represents income prepaid. So that's income prepaid. Therefore, the correct answer is B. Question 19. Annual rental income due from Kumar, a tenant. Okay, at the start of the year, Kumar has paid prepaid rent of 900, and at the end of the year, he owes money of 2 months rent. How much rent was received from Kumar? Now we have two methods of answering that question. Let's look at the first method. Now the opening balance, there's a prepayment of rent of 900. We're talking rental income here. A prepayment of rent by a tenant, okay, it's a liability, it's a current liability, because the customer has overpaid or prepaid his rent. Therefore, the opening balance is a liability, is going to be credit balance of 900. So this is the first entry. The second entry is annual rental is 3,600. Therefore, the amount which will be transferred from the rental income account or rent receivable account to the income statement at the end of the year will be the rental income for the year. Therefore, the transfer from the rent receivable will be debit, and credit to the income statement is 3,600. So this is the second entry. The third entry will be about the 2 months rent which is due. Now, if a customer owes money to the business, it's a current asset because it is amount owed by customer to the business. Now, a current asset, the balance brought down will be debit. Okay, therefore the balance brought down will be debit, but the balance carried down of the previous year will be on the credit side. Therefore, the balance carried down is 600, and therefore the amount received during the year is a balancing figure. It's 2,100. Alternately, instead of doing a T account, we can just calculate this figure directly. So we go as follows. We say that the annual rental income is 3,600. Therefore, the monthly rental is 300. Now, the opening prepayment is 900, which means Kumar had prepaid 3 months of rent, and he paid it last year. Therefore, the money was not received this year. It was paid last year. That's why it was an opening prepayment. And at the end of the year, the customer owes 2 months rent as stated in the question. Now, he paid the first 3 months last year. Okay, he was therefore due to pay the remaining 9 months. Okay, but we note from the question that of these 9 months, he did not pay all of them because he still owes 2 months rent at the end of the year. Therefore, it means during this particular year, the current year, Kumar paid only 7 months rent, isn't it? Because 3 months was paid last year. Of the remaining 9 months, he still owes 2 months. Therefore, he must have paid 7 months rent. Now, 7 months rent is equivalent to 2,700, just like we saw here. Therefore, the answer is A. Question 20. Joel's inventory at the end of the year was 4,800. However, he discovered there were 2 mistakes. The first mistake is goods costing 100 had not been included. It's a complete omission. Okay, it means the 4,800 did not include the 100. Therefore, the effect of this is the inventory has been understated. Okay, because it has not included. It's an understatement of inventory. Second item, goods costing 170 had been included at its net realizable value of 210. Now, this is against the prudence principle, because the prudence principle requires that goods should be valued at the lower of cost and NRV. Therefore, this is wrong. Therefore, the goods, this particular goods should have been included in the inventory at only 170 instead of 210. Therefore, this means that the inventory was overstated by the difference, which is 40. Okay. Now, the net effect of these 2 errors, okay, is that the closing inventory has been understated by 60. So, understated here by 100, overstated by 40. Therefore, the net effect is understatement of the inventory by 60. Now the effect of a lower closing inventory, it means the cost of sales was overstated, and because of that gross profit will be lower, and because of that lower profit for the year will be lower. Because of that the equity in the balance sheet to which profit is added, a lower profit would mean a lower equity. Okay, now equity is part of capital employed, because capital employed is equity plus long-term liabilities. Therefore capital employed will also be lower, and closing inventory, which is part of current assets, the current assets and also the total assets will also be lower. So this is the impact of an understatement of inventory. The question here, what is the effect of the incorrect inventory valuations on the financial statements? So the profit will be lower. Okay, so profit will be lower. So we're talking about 60 here. The profit will be lower by 60. Inventory also will be lower by 60, and equity also will be lower by 60. Therefore the correct answer is D. Question 21. The owner of a business took goods for his own use but forgot to make entries. What was the effect of this error? Okay, so you need to find the effect of this error. Now, what is a normal entry for drawings of goods? It is to debit drawings and credit purchases. Now, when the owner didn't make this entry, the effect of this error is that purchases, instead of crediting purchases, no credit was made. Therefore, the purchase account will be overstated. Okay, overstated because no credit entry was made for this drawing of goods. And the drawings account itself, this drawings of goods should have been a debit entry and would have increased the balance in the drawings account. Because no entry was made, the drawings account will be understated. Okay, now when the purchase account, purchase account is overstated, so a higher purchase is equivalent to a higher cost of sales, and it is equivalent to a lower gross profit, okay, which is equivalent to a lower profit. Okay, now drawings for goods goes straight to the balance sheet. It has no effect on profit for the year. Now, for profit for the year would be understated due to this error. Okay, so the answer will be either C or D. Now let's look at the capital account in a balance sheet. Okay. The capital account, essentially you have the opening balance, okay, the opening balance, which is balance brought down, okay. Then you add capital introduced during the year, okay. Then you add profit made during the year, but the drawings is a deduction. Therefore, you deduct drawings for the year to obtain the closing balance. Okay, so opening balance, you add capital introduced, you add profit for the year, you deduct drawings for the year to obtain the closing balance of capital account. Now the effect of lower profits here, okay, lower profits here would mean what? Would mean the capital account, okay, the capital account, because profit is added, the capital account will be lower. So the effect of item number 1 is that the capital employed, rather, the capital employed, okay, will be understated. Now to the item number 2 here, drawings is understated. Now drawings is a deduction, okay. An understatement of drawings will what effect will it have on capital employed? Okay, because the deduction here, when you have a lower drawings figure, the capital employed will be overstated. okay, because it's a deduction here. So the first item, it lowers capital employed, and the second item increases capital employed. Therefore, the net effect, one is lowering, okay, the other one is increasing. Therefore, the net effect will be 0. Okay, therefore the net effect will be 0. Okay, therefore the correct answer is C. Question 22. So Rajit and Sunil have a partnership. They don't have a partnership agreement, and now they want to draw up a new partnership agreement for future years. Okay, so the information have been given. So we ask which would be most beneficial to Rajit in year 2020. Okay, item number 1 is interest on capital. Now, this would be more beneficial to Rajit because he has contributed a much higher capital. Okay, interest on capital is calculated as a percentage of the capital account because he has got a much higher capital than Sunil. The interest on capital will be beneficial to Rajit. So this is a possible good answer. Item number 2, interest on drawings. Now, interest on drawings will not be good to Rajit. In fact, it will be to his detriment because he has higher drawing figure than his partner. Okay, interest on drawings is calculated as a percentage of drawings. A higher drawings amount will be equal to a higher interest on drawings, and interest on drawings is a deduction to the share of profits for a partner. Therefore, this is not good. It won't be to the benefit of Rajit. Item number 3, putting a limit on annual drawings. This also will not be to the benefit of Rajit because he has or will receive a higher interest on capital. Putting a limit on annual drawings can limit the amount of drawings to which he is eligible, but that limit will prevent him drawing his share of profit each year. Therefore, that's also no good to Rajit. Thirdly, partnership salaries. Now, because it says here the share of work is 50-50 between the partners, it would mean that the salaries to each partner will be equal. Therefore, it will make no difference to Rajit, and therefore it will not be particularly of any benefit to him. Therefore, the correct answer is item 1, which is interest on capital. Question 23. The following information is about Harry. He has received a salary, then he has drawings and share of profit. His opening credit balance on his current account was 28,200. We need to find what is the closing balance on his current account. That's fairly straightforward. Salary is credited to a current account. Okay, drawings is debited. Share of profit is added. Okay, the first closing balance will be the opening balance of 28,200 plus the salary less the drawings plus the share of profit. Therefore, its closing balance is 38,000. Therefore, the answer is B. Okay, question 24. The balance sheet of X Limited at December 2018, that's 2018, is as follows. Profit for the next year, so that's next year, 2019. Okay, profit is 42, then dividend paid, okay, so that's dividend paid, is 10,000. We need to find the total equity as of December 2019. Therefore, what we need to do here, first we need to calculate the opening equity, and then we look at the movements during the year to find the closing balance. Okay, now the first thing to note is debentures is not part of equity, so that's a trick here. We must ignore this figure. Okay, now the opening equity or the balance of the equity at 31st December 2018 okay, is a 40,000 here, okay, plus the 8,000 plus the 65,000. That's the ordinary share capital plus the general reserve plus retained earnings. So we have 113,000, which is the opening balance. Okay. Now movements during the year, we have profit. Dividend paid is a distribution, therefore it reduces the amount of equity of the business. It's a deduction. Therefore, a profit is 40,000 less dividend. So the movement is a positive 32,000 during the year. Therefore, the closing equity will be the opening figure of 113 plus the positive movement of 32,000 during the year. Therefore, the closing balance will be 145,000. The answer is B. Question 25 deals with the features of debenture. So let's look at the various features of a debenture. Okay, first one, normally a debenture, normally, not always, they carry a fixed rate of interest. Second, the interest is payable by the company, whether the company makes a profit or not. Debenture is just an expense. Okay, an expense. The company needs to make a payment whether it makes a profit or not. Thirdly, if a company is wound up or closed down, the debentures get paid before. They get paid before any shareholders, whether it is preference or ordinary shareholders, but they get paid after any secured bank loans. So the banks get their loans overdraft paid first. Then you have the debentures. Then you will have the preference shareholders, and last will be the ordinary shareholders who get some money in the case of wound out of a company. Fourthly, debenture holders are not shareholders; they're not members. Okay, they're just creditors, long-term liabilities, and therefore they do not have any voting rights. Okay. Fifth, normally but not always, debentures they are given security of assets by the company. Normally they have security of assets. And lastly, the debenture interest is just an expense. Okay, it's not a dividend, it's an expense. We call it a finance cost, and it appears in the income statement as an expense. So these are the main features of debentures. Now let's go back to the question. Question A, debentures are long-term liabilities. That's correct. Okay, debentures in fact is just one type of a long-term loan. Item B is they carry fixed rate of dividend. No, debentures do not get dividends. The debenture obtains interest. Okay, only preference shares which get a fixed rate of dividend. Okay, therefore this answer is wrong. Third, they carry voting rights. No, because they're not shareholders or members of the company. They do not have any voting rights. D, on liquidation, they are paid after shareholders. That's wrong. They get paid before shareholders. Therefore, the correct answer is A. Question 26 is about manufacturing account. Okay, which cost is part of the prime cost for a manufacturing business? Carriage inwards, yeah, particularly if carriage inwards is to do with the purchase of direct materials. That's correct. Carriage outwards, no, this is carriage paid on delivery to customers. Is a selling expense, and therefore it appears as an expense in the income statement. It is not an item in the manufacturing account. Factory rent, that's an indirect cost, also known as factory overheads, is not part of the prime cost. Prime cost includes only direct materials consumed, direct labor, and other direct costs like royalties. Factory rent is an indirect cost. Including factory supervisor salary, just like factory rent, is part of factory overheads. Therefore, it is not part of prime cost. Therefore, the correct answer is A. Question 27 is about a manufacturing account. So we need to find the factory cost of production. Okay. Now, cost of production is prime cost plus factory overheads plus opening work in progress minus closing work in progress. This is how it is calculated. So prime cost is 236, overheads is 42,000, opening is WIP is 8,000, closing WIP is 6,000. Therefore, cost of operation is 280. The answer is D. Question 28 is about sales ledger control account. Okay, I've given you a template here. That's for all entries in a sales ledger control account. Now, in our question, we have opening balance of trade receivables as a debit balance, because here trade receivables at the end of the year, so the closing balance will be 8,500, but the balance carried down will be on the credit side. Cash received, that's a debit bank, and therefore we credit the sales ledger control account. Irrecoverable debts written off, so it reduces the amount owed by trade receivables. It's a credit entry. 200, okay, and discount allowed also reduces the balance owed by trade receivable. It's a credit entry. Therefore, the balancing figure of credit sales is 38,585. Therefore, the answer is D. Question 29 is about the trading section of the income statement, and it's also about ratios because we have the markup percentage. Now, looking at the question here, we have revenue, we have markup. Using these two information, we can calculate cost of sales. If we get cost of sales, we have opening inventory, closing inventory, and drawings of goods. Therefore, we can easily find the purchases. Now, just a recap here. If markup is X divided by Y, gross margin is X divided by X plus Y. If gross margin is X divided by Z, then markup is X divided by Z minus X. A gross margin is always a lower percentage or fraction than the markup. Okay, in this question, markup is 50%, which is half. Therefore, gross margin is, applying the above formula, is 1/3. Now, gross margin is defined as gross profit divided by revenue. We have revenue, we have gross margin. Therefore, gross profit is revenue times gross margin, which is 30,000. Now, we know revenue, we know gross profit. Therefore, cost of sales is revenue minus gross profit, which is 90 minus 30. That's 60,000. Now, the definition of cost of sales in the trading section of an income statement. Cost of sale is opening inventory plus purchases minus purchases returns minus goods for own use plus carriage inwards minus closing inventory. Now, just substituting all the figures in this equation, we have cost of sales. So opening inventory is 8,000. Purchases we need to find out. 7,000 is goods for own use. Purchase return is nil here. Carriage inwards is also nil. And closing inventory is 2,000. That's minus 2,000. Therefore, by solving the equation, we find purchases is equal to 61,000. Therefore, the correct answer is D. Question 30 is about liquid or acid test ratio. It says that at the beginning of the year, the ratio was higher than at the end of the year. In other words, after a year, the ratio has fallen. Let's look at the definition of liquid ratio. Liquid ratio is liquid assets divided by current liabilities. Okay, liquid assets, the definition is it is trade receivables plus other receivables plus bank plus cash, but it excludes inventory. Current liabilities is trade payables plus other payables plus short-term loan plus bank overdraft. Now, for the liquid ratio to have fallen, it could be due to two factors. Either the liquid assets have fallen or the current liabilities have increased. Now let's look at the four possible solutions in the question. Question A, it says bank overdraft decreased. Now bank overdraft is part of current liabilities. Okay, a decrease in bank overdraft is equal to a decrease in current liabilities, and a decrease in current liabilities will increase the liquid ratio, not decrease it. We're looking for a decrease. Therefore, this answer is wrong. B, inventory has decreased. Now, inventory is not part of the equation of the liquid ratio. Therefore, the changes in inventory has absolutely no effect on the liquid ratio. Therefore, this answer is wrong. Thirdly, other payables, just like an bank overdraft, it is a current liability. Therefore, a decrease in other payables is the same as a decrease in current liabilities. A decrease in current liabilities will increase the liquid ratio, not decrease it. Therefore, this answer is wrong. Lastly, D, trade receivables has decreased. Now, a decrease in trade receivables, it is equivalent to a decrease in liquid assets, and this will in turn decrease or reduce the liquid ratio. Therefore, this is the correct answer. Therefore, the answer is D. Question 31 is about ratios. So we note between year 1 and year 2, profit margin has increased, okay, significantly, okay, and return on capital employed has decreased. Now, return on capital employed, the definition, it is profit for the year, okay, profit divided by capital employed, okay. Now, capital employed in itself, it is equity plus long-term liabilities. So that's the definition of capital employed and return on capital. So let's see of the four solutions, which one would have caused these two changes. First, we note such a big increase in the profit margin from 15 to 20% would have been caused most likely by a significant increase in profit. Therefore, we're looking for an increase in profit. Now, secondly, if profit has increased, yet we see return on capital has decreased. Now, the only reason for the decrease or the explanation for a decrease in return on capital employed, despite an increase in profit, would be a significant increase in the capital employed. Therefore, either the equity or the long-term liability must have increased significantly. Therefore, let's look at all the four possible answers. A, it says as drawings have increased by more than profit for the year. Now, if drawings has increased, drawings is part of equity, it's a deduction. An increase in drawings would reduce equity. A reduction in equity will reduce capital employed. A reduction in capital employed will increase the return on capital employed, not decrease it. Here we're looking for a decrease. Therefore, this answer is wrong. Item A is wrong. Item B, gross profit has increased, but profit for the year has decreased. It says profit for the year has decreased, whereas we're looking for a significant increase in profit. Therefore, this is also wrong. Third, profit for the year has increased and capital has been introduced. So profit for the year has increased, correct, that's what we're looking for. Now we're also looking for an increase in capital employed, okay. Now, an introduction of capital will increase equity, it will also therefore increase capital employed. An increase in capital employed will reduce the return on capital, therefore this is also good. D, profit for the year has increased and a long-term loan has been repaid. Now profit for the year has increased, that's good. It says the long-term loan has been repaid. Now, a long-term loan is part of long-term liabilities. Repayment of long-term loan means a reduction in long-term liabilities. A reduction in long-term liabilities will reduce capital employed. A reduction in capital employed will increase return on capital, not decrease it. Therefore, this is wrong. Okay, therefore the correct answer is C. Question 32 is about uses of accounting information. Two important terms which we need to note. First, it's talking about accounting ratios and external parties. Okay, a quick recap. We have internal and external parties who use accounting information. Internal parties include managers, employees, and owners of the business, because these are insiders to the business. External users, there are many examples of external users, or trade unions, government agencies, which will include tax authorities and regulators. You have investors who are potential future owners or providers of other types of capital. You have suppliers, customers, competitors, bank and other credit providers and lenders. You have business analysts, advisors, academics, researchers, including students. You have the financial press, stockbrokers, non-governmental organizations, pressure groups, and the general public. Now, going back to our question, item A is talking about government. Now, government does look at the financial statements of a business. In particular, they look at the income statement. Okay, the tax authorities in particular, they look at income statements so that they calculate the tax due by the business to the government. As regulators, okay, they also require other information to ensure the company is compliant with various laws and regulations. But for these two requirements of tax calculations and compliance with laws, they do not need accounting ratios. Here we're talking about accounting ratios. Therefore, government has got no use of accounting ratios. Therefore, answer A is wrong. Answer B, investors, that's correct. Investors do use, in fact, investors, the main information, accounting information they use are ratios, because the ratios, they can use ratios to calculate the profitability of a business in a particular year, and also the profitability trends to see whether the profit margin or the return on equity or capital employed is going up or down. They use ratios to calculate liquidity, like current asset ratio or liquidity ratio. They also look at gearing ratios, efficiency ratios, to see whether the company is going the right direction or is going the wrong direction, whether the performance is improving or going in a negative way. Therefore, investors do use accounting ratios. Therefore, this is a possible good answer. C, managers. Managers are not external parties. That's why we talked about external parties here. Managers, they do use accounting ratios, but they are internal parties, not external parties. Therefore, this is the wrong answer, because we're looking for external parties. Lastly, tax authorities. We have looked at it before in government. Tax authorities is just a government agency. Tax authorities, they use income statement, but they have no use of accounting ratios. Therefore, this is wrong. Therefore, the correct answer is B. Question 33 about accounting principle. Okay, it says the company did not account, therefore it did not record at all unused stationery valued at $50. Now, because it is such a small amount, obviously it's got nothing to do with matching, it's nothing to do with money measurement, prudence, that's something else. The correct answer is materiality. Okay. Now, just for revision, let's look at the definitions or the requirement of materiality principles. The materiality principles applies to items of very low value, like in our example, okay, which are not worth recording. Okay, examples could be a small calculator, okay, and other non-material items. Okay, it also says that the materiality will vary from business to business. Now, a very large business which has got billions of turnover, okay, the materiality level could be 100,000, but for a small business with a turnover of maybe only $20,000 a year, even $50 could be material. So that's also important to note. And it also says this principle is applied by entering small expenses into a general, sundry, or miscellaneous expense. Okay. We also take note that this principle applies to inventories of office supplies, okay, such like examples like stationery, which is just a charge to an expense account instead of treating it as part of the inventory. Therefore, the correct answer here is B, because we'll be looking at a very small amount of $50 of stationery. It's just the cost of recording it is probably outweighs $50. Therefore, the answer is B. Question 34 is about accounting principle. Okay, a trader wrote off the balance on a credit customer's account as irrecoverable. Which accounting principle was applied? Now, we're talking about a potential loss which the trader has decided to account for that loss in the year. Now, obviously, it is about prudence concept. Let's look at the definitions of a prudence concept or principle. The prudence principle is also known as a principle of conservatism. Okay, this principle ensures that accounting records present a realistic picture, okay, of the business. Okay, however, it does not allow deliberate understatement or overstatement of certain items in the financial records of the business. In short, it does not permit bias. So you can't deliberately overstate your assets or overstate your income or understate your liabilities and expenses, although the business requires to be realistic. Now, the principle requires that the business assets are not overstated and liabilities are not understated. So it requires that profits and assets are not overstated and liabilities and expenses are not understated. It further says that the business should never anticipate a profit. Okay, only when the profit is earned, then you recognize. But if a possible or future loss is known or probable, it should be already accounted for. Okay, profit should only be recognized when it is reasonably certain to be realized. However, all possible losses should be provided for. Therefore, when a business anticipates a future loss, although the loss might happen or might be realized in future years or in the following year, in this current year, you should already make a provision for the loss. So that's the premise of prudence principle. It further says, in a situation where there's a conflict, okay, between prudence principle and another principle, the prudence principle always has priority. So prudence principle will always have priority, for example, on matching concept, which requires revenue to match with corresponding losses. So in this case, recognizing a loss, although it hasn't happened, okay, in the current year, basically the prudence principle is overriding or taking precedence on the matching concept. Therefore, the answer to this particular question of recognizing a future loss now is requirement of the prudence principle. Therefore, the answer is D. Question 35 is about accounting objectives when choosing accounting policies in preparing financial statements. Here, just talking about comparability. Okay, let's look at the definition of this term. Now, comparability means information contained in the financial statements can be useful if can be compared with similar information about the same business, okay, for various accounting periods. It's also useful if this information can be compared with other businesses, okay. To make good comparisons, changes, okay, in accounting policies must be properly disclosed so that users can compare it judiciously. It is also noted that it is important to identify similarities and differences in the financial statements so that users can make better judgments. Now, coming back to our question, okay, what is the effect of this on interested parties? A, they can make sure that information is up to date. No, that's nothing to do with comparability. B, they can identify similarities. That's right, yeah. So, this is a good answer. It's about identifying similarities between businesses to make comparison. C, to understand financial statements easily. No, that's not comparability. Lastly, they can use financial statements in decision making. That's nothing to do with comparability. Therefore, the correct answer is A. Dear students, I sincerely hope that you enjoyed this video. I certainly did, and that it will help you in your revision. If you did like the video, please give it a thumbs up, and please subscribe to my channel. For your information, I'll be posting some more videos in the days to come. See you soon, and good luck in your exam. Cheers.